On a single morning, while the world slept, 674 million ounces of paper silver flooded the Shanghai exchange. That's nearly double the entire year's global mine production. Traded in just hours, but here's what doesn't make sense. At the exact same moment, 3 million ounces of physical silver vanished from Western vaults. Every single futures contract settled for actual metal. Not paper, metal. The price crashed 22%. Yet the metal disappeared. Someone is buying what others are desperately selling. And what happened next reveals something far more calculated than anyone is willing to admit. Welcome to the boring currency. If you've reached this point in your life where you value substance over noise, where you prefer analysis over entertainment, then you're in the right place. We don't do hype here, we do homework. Now, if you would appreciate having access to these economic briefings regularly, the kind your financial advisor probably is not sharing with you, would you consider subscribing? Think of it as keeping a reliable research desk on standby. Just click that button below. And tell us, from which corner of the world are you watching this? Are you in New York, London, Dubai, Singapore? Drop your location in the comments. It helps us understand who's paying attention and why. Now, let's examine what really happened to silver. February 4th, 2025, a date that will be remembered in commodity market history, not because of what was announced, but because of what was executed. At 9:30 a.m. Shanghai time, silver was trading at $90 per ounce on the Shanghai Futures Exchange. By 11:30 a.m., it had collapsed to $73, a 22% free fall in 2 hours. Traders across Asia watched their screens in disbelief. Portfolio managers in London woke up to margin calls. Risk officers in New York scrambled to understand what had just broken. This wasn't a normal correction. This was something else entirely. The numbers told a story that seemed impossible. Western spot silver sat at $75 per ounce. Western futures markets showed $76, but Shanghai spot still held at $86. Shanghai futures remained at $90, a $10 premium. Even after the crash, Chinese markets were pricing silver significantly higher than the West. That shouldn't happen. When markets crash, they crash everywhere. Premiums disappear. Arbitrage traders close the gap within minutes. That's how global markets work, except this time, they didn't. Gold, for context, was trading calmly at $2,921 per ounce. No panic, no volatility, just silver in complete chaos. For weeks leading up to this moment, technical analysts had been watching a critical resistance zone. The $87 to $90 range had rejected every upward attempt. 3 times the price had tested that ceiling. 3 times it had failed to break through cleanly. Each rejection left a mark. Each failure to close above $90 signaled that something was holding the price down. Pressure was building. The chart patterns were clear to anyone who understood market structure. This wasn't speculation. This was documented, verifiable price action. And then it broke, but not upward, downward, with devastating force. The question every serious analyst immediately asked was simple. What triggered this? Markets don't collapse 22% in 2 hours without a catalyst. There was no geopolitical shock, no central bank announcement, no industrial demand crisis, no mine collapse, no regulatory change. Just volume, massive, unprecedented volume. The Shanghai Futures Exchange recorded something that had never been seen before in Asian commodity markets. In a single morning session, traders moved 1.44 million contracts on the April 2026 silver futures alone. Let that number settle. 1.44 million contracts. Each contract represents 15 kilograms of silver. That's roughly 674 million ounces of paper silver, traded in one morning. Across all contracts that day, the total reached 1.34 billion ounces. To put that in perspective, the entire world mines approximately 800 million ounces of silver per year. Every mine, every country, every ounce dug from the earth. In 12 months, Shanghai traders moved nearly double that amount in paper form and in hours. This wasn't retail investors panicking. Retail doesn't have that kind of firepower. This wasn't even large hedge funds repositioning. The scale was too coordinated, too systematic. Someone, or some group, dumped an enormous position onto the market with one clear objective: crash the price, and they succeeded. But here's where the story becomes genuinely strange. Despite the paper market collapsing, physical silver wasn't following the same script. The backwardation structure, where near-term prices trade higher than future prices, remained intact. That's the opposite of what should happen during a panic sell-off. The exchange for physical spreads, which measure the premium for actual metal versus paper contracts, were signaling tightness, not abundance. Tightness. In London, spot prices had moved into backwardation versus COMEX. That's a red flag. It means people want metal now, not promises of metal later. The market was saying two completely opposite things at the same time. Paper silver was screaming, "There's too much supply, sell everything." Physical silver was whispering, "We need metal, now, at any price." One of these signals was real. The other was engineered. Experienced traders, risk managers, and commodity analysts who had spent decades in these markets were calling the situation unfamiliar. That's a professional way of saying, "We've never seen this before, and we don't fully understand what's happening." What they did understand was this: something fundamental had broken in the silver market, and the fracture was only beginning to show. While Shanghai was burning, COMEX vaults in New York were emptying. February 3rd, 2025, one day before the crash, the commodity exchange, COMEX, published its daily vault report. These reports are public record, dry, technical. Most people never read them. But on this particular Tuesday, the numbers were screaming. 3 million ounces of physical silver withdrawn in a single day. Not transferred between vaults, not reclassified from eligible to registered, withdrawn, gone, removed from the system entirely. The breakdown was surgical. Asahi refining, 2 million ounces out, HSBC, 900,000 ounces out, JP Morgan Chase, 282,000 ounces out. These aren't small players. These are the backbone institutions of the precious metals market. When they move metal, it means something. But there was more. Loomis registered inventory absorbed 2.5 million ounces in adjustments. Total COMEX silver inventory dropped to 400 million ounces. That's the lowest level in years. Now, pause here. Imagine you're running a business. Your warehouse is being drained. Your inventory is falling. Your customers are demanding more product than you can deliver. What happens to your prices? They go up. Supply and demand. Economics 101. Except in the silver market, prices were about to collapse. This is the contradiction that should make every person watching this uncomfortable. Physical metal was leaving the system at an accelerating rate, while paper prices were preparing to crash. Someone was buying everything available, while someone else was selling everything imaginable. But here's where it gets even stranger. Futures contracts, those paper agreements to deliver silver at a future date, were behaving in a way that commodity veterans had rarely witnessed. Normally, when a silver futures contract expires, only 1% to 3% of contracts actually settle for physical delivery. The rest get rolled forward or closed out in cash. That's standard practice. The futures market exists primarily for price discovery and hedging, not physical delivery. But in the first 4 days of February 2025, 100% of contracts were settling physically. Every single one. Over 3,500 contracts, all accepted for physical delivery. That's 17.5 million ounces in just 4 days. No rollovers, no cash settlements, no extensions, just metal. Buyers wanted the actual silver, not the paper promise, not the financial exposure, the metal itself. And they were taking delivery immediately. Think about what that means. In a normal market, futures are abstract financial instruments. Tools for speculation, hedges against risk. Very few participants actually want the physical commodity. But when 100% settlement happens, the market isn't functioning as a financial instrument anymore. It's functioning as a supply chain. And supply chains only behave this way when there's a shortage, or when someone knows a shortage is coming. Now consider the industries that depend on silver. Solar panel manufacturers need silver for photovoltaic cells. Electronics companies need silver for circuit boards. Medical device producers need silver for antimicrobial coatings. Defense contractors need silver for missile guidance systems and radar technology. AI data centers, those massive facilities everyone is building to power artificial intelligence, require silver for high-performance computing components. You cannot build these with paper contracts. You cannot manufacture missiles with futures agreements. You cannot print circuit boards with financial derivatives. You need metal. Real, physical, deliverable metal. And the world was waking up to a harsh reality. There might not be enough. The data was undeniable. Vault withdrawals accelerating. Settlement rates at 100%. Industrial demand surging. Mine production flat. Recycling unable to fill the gap. Yet the price was about to be destroyed. This wasn't a market discovering equilibrium. This was a market at war with itself. On one side, physical buyers, desperate for metal, willing to take delivery immediately, draining every available ounce from institutional vaults. On the other side, paper sellers, flooding exchanges with massive short positions, creating the illusion of unlimited supply, driving prices down with pure leverage. One side was playing the real economy. The other side was playing the perception economy. And for a brief moment on February 4th, perception won. But perception doesn't build solar panels. Perception doesn't manufacture semiconductors. Perception doesn't launch satellites. The physical world was about to send a very clear message. Paper games have limits, and those limits were closer than anyone realized. The question wasn't whether the divergence would resolve. The question was how violently it would snap back. There's a saying in commodity markets: volume reveals intent. When large amounts of a commodity trade hands quickly, it's not random, it's designed. Someone wants something to happen. And on the morning of February 4th, 2025, someone wanted silver to die. The Shanghai Futures Exchange opened at 9:30 a.m. local time. Within minutes, the floodgates opened, not gradually, not in waves, all at once. Paper silver poured into the market like a dam had burst. 1.44 million contracts on the April 2026 silver futures in a single morning session. Let that number sit for a moment. Each contract represents 15 kilograms. Do the math. That's 674 million ounces of paper silver moving through one exchange in one morning. But it wasn't just April contracts. Across all silver futures that day, 1.34 billion ounces traded. Billion. With a B. Now, here's the context that makes this number insane. The entire global silver mining industry produces roughly 800 million ounces per year. Every mine in Mexico, every operation in Peru, every refinery in China, every ounce extracted from the earth across 12 months. Shanghai traded nearly double that in paper form before lunch. This wasn't a market, this was an execution. Traders who had been in Asian commodity markets for decades were calling colleagues. Risk managers were pulling up historical data. Exchange officials were monitoring systems for technical glitches, because volume like this doesn't just happen. Markets have rhythm. Even during panics, there are pauses. Buyers step in, sellers hesitate, prices bounce. That's organic volatility. This wasn't organic, this was systematic, coordinated, relentless. Someone had assembled an enormous short position, and they were dumping it all at once with one clear objective: break the market, break the psychology, break the momentum. And most importantly, break the Chinese premium. For weeks, Chinese silver markets had been trading at a significant premium to Western exchanges. This wasn't supposed to happen in globally connected markets. Arbitrage traders should immediately close those gaps, but they couldn't. Because the premium wasn't about pricing inefficiency, it was about supply reality. China has the manufacturing base, China has the industrial demand, China has the solar panel factories, China has the electronics production, China needs physical silver, not financial exposure. And Chinese buyers were willing to pay more. Because they understood something Western traders didn't. Paper silver is infinite. Physical silver is not. So when 1.34 billion ounces of paper silver hit the Shanghai Exchange in one morning, it was a message, a warning, a demonstration of power. The message was simple. We can flood this market with paper whenever we want. We can crash your premium. We can destroy your price structure. We control the narrative. But here's what the paper sellers didn't count on. The physical buyers didn't blink. Even as prices collapsed from $90 to $73, the premium structure held. Shanghai spot remained at $86, a $10 premium over Western markets. Even after the crash, that shouldn't be possible. When a market crashes 22% in 2 hours, fear takes over. Buyers disappear, premiums evaporate. Everyone rushes for the exits, except they didn't. Chinese industrial buyers, strategic funds, and state-backed entities kept buying physical metal. They ignored the paper chaos. They ignored the volatility. They ignored the fear. Because they understood something critical. This wasn't about price. This was about access. And here's where market mechanics revealed something extraordinary. Despite the massive paper dump, the backwardation structure remained intact. Backwardation is when near-term contracts trade at higher prices than future contracts. It's the opposite of normal market structure. And it signals one thing: immediate demand exceeds immediate supply. People want metal now, not later. That's a supply crisis signal, not a surplus signal. Yet the price was collapsing. In London, spot prices had moved into backwardation versus COMEX futures. The EFP spreads, exchanged for physical, were widening. That measures the premium you pay to convert a paper contract into actual metal. And that premium was rising, even as paper prices fell. Think about that logic. Paper silver is crashing, but the premium to get actual metal is increasing. That's not a market in panic. That's a market in shortage, disguised by paper leverage. Experienced risk managers were using words like unfamiliar and unprecedented in their internal memos. These are professionals who lived through 2008, who traded through the 2011 silver spike, who navigated the 2020 pandemic disruptions. And they were calling this different, because they'd never seen a market where paper and physical completely decoupled, where the price signal and the supply signal told opposite stories, where leverage could crash prices, but couldn't create metal. The paper game had reached its limits, and what happened next would reveal just how fragile those limits were. Because while traders were celebrating the price crash, vaults were still emptying, contracts were still settling physically. And industrial buyers were still taking delivery. The war wasn't over, it was just beginning. Every market disruption leaves clues, not in what happened, but in what comes next. And what came next in the silver market wasn't resolution, it was escalation. The February 4th crash wasn't the end of a story, it was the beginning of a question that business leaders, treasury managers, and strategic planners need to answer immediately. What do you do when the price of something falls, but the availability disappears? This is the paradox now facing every industry that depends on silver. Solar manufacturers, looking at their Q2 procurement budgets, saw silver prices drop 22%. Their finance departments celebrated. Their supply chain teams panicked, because lower prices mean nothing if you can't secure supply. Electronics producers who delayed orders hoping for further price drops discovered something unsettling. Their suppliers were now quoting longer lead times, higher minimum order quantities, requests for advance payment. The paper market said, silver is abundant. The physical market said, silver is scarce. One of these signals is lying, and betting wrong could shut down production lines. Defense contractors building missile systems don't have the luxury of waiting. When the Pentagon issues a contract for guided munitions, you deliver, on time, no excuses. But silver is a critical component in radar systems, guidance electronics, and thermal management. If your supplier can't deliver, your contract is worthless. Medical device manufacturers face similar constraints. Antimicrobial coatings for surgical instruments require silver. Hospital procurement doesn't pause for market volatility. And then there's the AI revolution. Every data center being built to power artificial intelligence requires massive amounts of silver. High-performance computing, server infrastructure, cooling systems, power distribution. These facilities are being constructed right now. Billions of dollars already committed. Construction timelines locked in. You cannot call a halt to a $500 million data center build because silver became unavailable. So the question for capital allocators becomes urgent. Do you lock in supply now, even at elevated prices? Or do you wait? Betting that the paper market collapse reflects real abundance. This isn't a theoretical exercise. This is a decision being made right now in boardrooms across every industrial sector. And the data suggests the smart money already made its choice. Those 3 million ounces withdrawn from COMEX vaults, someone took physical delivery. Someone moved that metal into private storage. Someone decided that owning the actual commodity was worth more than holding a paper contract. Those 3,500 futures contracts settling 100% physically, those weren't speculators. Speculators roll positions. They avoid delivery. They trade price movement. Industrial users take delivery. Strategic buyers take delivery. Entities preparing for supply disruption take delivery. Now layer in the geopolitical dimension. China maintained a $10 premium throughout the crash. That's not market inefficiency. That's strategic positioning. China understands something Western financial markets are slow to accept. In a world rapidly fragmenting into competing economic blocks, commodity security is national security. You cannot build a technology-independent economy if you're dependent on external suppliers for critical materials. Silver isn't just a precious metal. It's a strategic input for renewable energy, military systems, consumer electronics, and advanced manufacturing. Controlling supply means controlling industrial capacity, and China has been systematically securing physical commodities while Western markets play paper games. The premium isn't a bug, it's a feature. It's China saying, we'll pay more because we understand what's coming. So what is coming? 3 scenarios are now in play. Scenario 1, systematic deleveraging. The crash was simply over-leveraged speculators getting liquidated. Prices will stabilize. Physical supply will normalize. Markets will return to equilibrium. This is the optimistic view. It's also increasingly unlikely. Scenario 2, coordinated suppression. The crash was intentional, designed to keep industrial input costs manageable, executed by entities who benefit from lower commodity prices, central banks, large manufacturers, financial institutions with short exposure. The goal? Maintain the illusion of abundance, while quietly securing physical supply. This explains the contradiction. Paper crashes, physical disappears. Scenario 3, monetary system restructuring. The crash is a preview, not of silver's future, but of the entire commodity-based monetary system. As currencies lose purchasing power, as debt levels become unsustainable, as trust in fiat systems erodes, hard assets become the new reserve base, and silver, industrial, monetary, and strategic, becomes a battlefield. Each scenario has different implications for capital allocation. If scenario 1 is correct, wait, prices will fall further, buy the dip, business as usual. If scenario 2 is correct, secure supply now, accept higher costs, protect production continuity, hedge with physical holdings. If scenario 3 is correct, reallocate entirely. Treat silver not as an input cost, but as a strategic asset. Build inventory reserves. Establish direct supplier relationships. Prepare for supply chain fragmentation. The evidence leans heavily towards scenarios 2 or 3, because markets don't move 1.34 billion ounces of paper in one morning by accident. Vaults don't empty at record rates during price crashes without reason. Industrial buyers don't accept 100% physical settlement when everything is abundant. The signals are clear. The physical market and the paper market have decoupled. And when that happens in commodity markets, the resolution is never peaceful. History provides the roadmap. Oil in the 1970s, gold in 2008, palladium in 2020. Every time paper markets diverged from physical reality, the physical market eventually won, violently. The only question is timing. And for business leaders making decisions today, timing is everything. Because if you wait for certainty, you'll pay the premium of being late. If you act on incomplete information, you risk overcommitting capital. The answer isn't in prediction. It's in preparation. Audit your silver exposure. Understand your supply chain dependencies. Identify alternative suppliers. Evaluate physical inventory strategies. Stress test your procurement assumptions. And most importantly, stop treating commodity markets as purely financial constructs. They're not. They're the physical foundation of industrial civilization. And that foundation is shifting. What happened to silver in 2 hours wasn't just a price move, it was a warning. The question is whether anyone is listening.